Welcome to TheoTrade. This is Don Kaufman. It's August 22nd, 2018. You are watching the Theo Night video. Markets largely unchanged in today's trading session, even though the fact that we had the FOMC Minutes come out today, it really produced some rather short duration volatility. I think it moved, but barely today. So the S&Ps having a most of their range in the overnight trade, for the most part, are with about 10 minutes left on the trading day. We're going to finish largely unchanged. The Nasdaq grinds slightly higher, which brings me directly to it. Let's talk a little bit about a trade and a trade opportunity that happens to present itself here in the FXE. Now, if you're not familiar with this, it is an ETF product. It's an ETF product of the euro. What's the euro? Again, you could look at the euro versus the US dollar, but this is an ETF product of the euro in this circumstance. And the euro, of course, has been slipping quite wildly up until much more recently, which we've had a wild, what we kind of term a rip-your-face-off rally. Now, nevertheless, I look at this as a little bit of an opportunity if you still believe that there's going to be more downside in the euro, that this really is, again, just a bit of a short covering, a bit of what we, again, term kind of that rip-your-face-off rally. We're going to step in right now and place a number of different short positions, and I'm actually going to take you through some of those short positions. Now, it's not often that I step in to the currency world. And the reason is it's just a highly political environment. It's constantly politicized, especially right now during these trade wars. But I really view this as a decent opportunity to kind of short into what has been, again, kind of a wild and woolly bounce. You know, I hesitated on this trade and really wanted to see what was going to occur following the FOMC minutes. And for the FOMC minutes, probably the best way to kind of explain this to you is to actually not look at the euro, but to look at the dollar itself and what the impact of the minutes happen to be. Well, here they are. You know, we talk about lack of volatility. Well, there was some volatility, momentary volatility, if you will, specifically inside of the dollar. But the overwhelming theme is, well, those minutes, they didn't dictate very much. So here we are, again, looking for a short position in the FXC. And if you're not familiar with it, if you're not, necessarily comfortable trading some of the currency or currency ETFs, you could also look at the EEM. The EEM happens to be the emerging markets. Listen, the EEM and the relationship to the euro, it's not exactly like a one-for-one, but it's fairly close. In fact, I think it's worthwhile to go up here to studies, go over, and we're going to compare with, cruise down to a custom symbol, and I'll type in FXE. So a little bit of a comparison chart. You can see the relationship is fairly tight. And if you take a look at EEM, this has also been a bit of a bounce. However, the bounce inside of FXE, I'm going to get that right, has been vicious in comparison, if you will, to the emerging markets. So what types of trades might I look for in here? And the one thing I like to be really adamant, very, very specific about is that when I am constructing a trade, it's always about the trade logic. Yeah, the chart's set up, it's a rip-your-face-off rally, and, I look at this and I think, all right, it's not necessarily sustainable, this thing will probably come back in, and I've actually been looking for some entrance into short positions in the euro. I just haven't gotten great opportunities. I mean, the euro has been pretty much a straight shot to the downside, very little bounce. It's the best opportunity we've had to enter into the euro since really, the beginning of the year. So that's why I'm entering into it. But as I was saying, listen, my trade, it's not about what I think here. It's not about what I think in the chart. What do I see in the chart? I don't know. What I do see, though, is opportunity in the options chain. Now, there are two completely unique trades I'm going to display to you. One of them is termed the in-out spread. You can see I've been filling these throughout the course of the trading session, and I'm carrying a position. So in this in-out spread, This happens to be a 112, okay, 110 put spread 30 days out in time. Now, there's again not a whole lot to the spread. Well, what's the risk in the spread? Risk in the spread is approximately 86 cents. And I have found in here today that I could fill pretty much right at the mid price. So just be aware of that. So you have about 86 cents of risk. What are you trying to make? Well, in these in-out spreads, listen, what's the most you can make on a $2 wide spread? Well, you can make $2, but you can't make the $2 until expiration. So I'm really trying to net make about 55% on my 86 cents. And as I said, like every trade kind of has its logic associated with it. And you may question to yourself, well, why would I want to risk that 86 cents to be able to make a mere 55%? And the answer lies in what we term the probability of touching, and that is the probability of making the 55%. Again, the probability of making the 55% is drastically higher than losing the full 86 cents. Okay, it's actually a fairly high probability trade, and this is an area of trading that very few, okay, really go this deep, and they don't necessarily spend the time to look like, hey, what's the probability per se of touching, okay, a particular strike or a particular area anytime between now and expiration. So again, it's a very straightforward trade. There's no stop order used in here. Come on, your risk is 86, 87 cents. Let fly, try to make it 55%. The other trade that I've actually embarked upon happens to be looking at the 115, again, the 115 puts. Now, with the 115 puts, all I'm doing, I'm just buying an in-the-money put. It couldn't be easier than that, right? Why am I buying in the money put? If you buy, all right, in this case, a 115 put, the 115 put gives the right to sell the stock at 115. But if I buy that put, what I want the stock to do? Go down. Why am I using the 115 put? Because it has north of an 85 delta. It's a put with over an 85 delta, which means I'm getting about, well, in this case, I'm actually getting even better than I'm getting about 89 cents bang for the dollar move in this product. So if the product moves up a dollar or down a dollar, I'm actually going to be making maybe 90 cents of that dollar in here. And the nice thing is it's much easier than just going out and shorting a product. Because you short a product, it's going to tie up a ton of capital. In this case, what do I tie up? Well, I filled one a little earlier, and I actually filled it, okay, for $3.75 on the day. But hey, do your best to work your order even better than mid. Right now, I'd try to work this thing probably at $3.85. So I really wanted to elaborate on two vastly different trade ideas in this particular circumstance. So when I say vastly different, listen, this October put, that's a longer duration trade. This is something that I'm not going to be bailing out of when I make money, right? I'm going to be taking this trade, I'm going to be rolling it, okay? I'm going to be massaging it over time. I'm going to love it, all right? The in-out spread, it's just that. I'm in it right now, and I'm getting out when I make my 55%. So whether you want to be kind of that shorter duration options trader, or whether you actually want to be in that euro and short for a longer period of time, well, select your trades. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.